Bob Bound, who's going to give us a quick overview of the charitable trust stuff that we've been talking about for a while, mostly for the benefit of Eric and Paul. And I don't see Mr. Murphy here today, but he'll go through those. And then what I've asked Bob to do is he's also going to go through and speak about what some of the proposals are that the Biden administration is proposing in terms of capital gains and some other things that are really going to make this program so much more valuable to prospective donors than it has been in the past. Please take it away, Bob.
Great. Well, thank you, Chris. So yeah, we're at sort of an exciting time from a planned giving standpoint because of the perhaps challenging tax law changes that appear to be heading our way. I will get into specifics of how those will possibly impact our work. But this first slide here kind of talks about in the planned giving realm, there's just this reality that as a family, your money is going to go to one of three spots. You got your family, you've got possible charities, and you've got the government. And we can, in our planning, do a lot of work to make sure that we maximize how much goes to families, how much goes to charities, and minimizing how much goes to Uncle Sam. I don't know many clients that I've met with over the last 25, 30 years that are excited about giving Uncle Sam more than they're already giving in taxes. And so part of what we have an opportunity to do on this committee is to articulate some possible planning ideas with potential donors that we come in contact with in our different spheres of influence. So that's part of what we're going to be focusing on today. Charitable trusts are a key facet in the planning toolbox. And we're going to go over some of the basics of that. This slide here discusses just the basics of charitable deductions that I think probably everybody's aware of. If you're giving assets to charities, you get a straight line deduction off of your income, up to 50% of your adjusted gross income, if that gift is made to a publicly supported charity like the hospital. And so that basic tenet, people are aware of. Everybody's donated some money and they get donations at the end of the year. But what we have an opportunity to be able to share with people are some unique opportunities that come when we're dealing with things like appreciated assets. Obviously, appreciated assets for all of us as individuals have sort of this idea of a built-in capital gain that's there, right? We bought stock here for $50,000. It's now worth $200,000. It's a $150,000 gain. If we want to make that stock and to turn that stock into money and we sell it, we've now got capital gains taxes on that $150,000. You see in this slide just some basics of how that works out. In 2021, we've got a long-term capital gain tax rate of up to 20% and California rates up to 13.3%. That's $49,950 of $150,000 gain is now headed towards Uncle Sam. So this idea of people that have appreciated stock portfolios or appreciated real property, and we're obviously a real estate subcommittee here. And so, we're coming in contact perhaps more frequently with this real estate that people have owned for a long time. That capital gain that's sitting there is a huge burden and prevents people from selling sometimes that they would rather sell. They'd like to liquidate. They'd like to diversify. They've got a property that is old and they don't want to put more money into it, but they don't want to sell it. We've talked before on this committee how that kind of gets into this trap for donors, because we've had people that we've spoken to. They have an old apartment building. It hasn't had a whole lot of money put into it. It's got a ton of deferred maintenance. They don't feel like they can then charge market rents because the property is in poor condition. And so the income that's happening on that property is sort of dwindling. And so they really get stuck. And we have an opportunity through the use of these charitable trusts to really sort of unlock that money for those particular donors. The idea of a charitable trust, as this slide points out, basically splits interest, considers the interest on an asset into two pots. You've got the income stream that is available, and then you've got the asset that's left after perhaps a donor passes away that's the remainder interest. And so the quote down on the bottom of the slide, I like this. I think it's sometimes helpful when we're talking to donors about these concepts. It says, wealth is like an orchard you've built up over a lifetime. Taxes start taking the trees from your orchard. And when the trees are gone, there's no more apples. This idea of this charitable trust that we'll be going into really sort of plays on that concept of you've got the trees and you've got the apples. And we, as in offering options to clients, we can kind of find out from them sort of what's more important. Many people really are focused on the income, and they're living on the income, and they really want to maximize their income. And for those clients, sort of the charitable remainder trusts are the sort of ideal fit. The idea is that, again, the individual gets to keep the apples for life, and then they put assets in a trust. They get the apples. The trees go to charities when the person passes away. If you could use some of this income for people that have an insurance background on this committee. You can use some of this income to purchase insurance. Sometimes you'll get discussions with people that will say, well, so if I do this, Bob, I see I'm getting significantly more income here, but then when I die, my kids aren't going to get anything. And that concerns me. For those clients, we can layer in the use of insurance. And with the increased income stream that can frequently be had by the use of these trusts, we can allocate some of those funds to insurance to sometimes replace the wealth that may have been lost by the gift to the charity. And so in that sense, we are sort of maximizing our overall planning. And a couple slides later, we'll go into that in a little bit more detail. But that's one of the basic concepts that we can use in the charitable remainder trust. So this slide just visually shows this. We've got John and Mary, potential donors. They create this charitable remainder trust. That's CRT. That's providing an income back to them for life. So they're getting this income stream. And when they pass away, the asset passes to the charity, in this case, the hospital. And the hospital now has this significant gift. I can click to the next slide. Again, you see some of the benefits of CRTs. Huge benefit to charities. These gifts, because as you're kind of seeing, they tend to be much larger than a person's annual gift. You can create an opportunity for the hospital to receive a building, right, that has a significant value. But for clients also that we talked about that are in this spot where they have an asset that maybe, again, is dilapidated, has a lot of deferred maintenance, is paying a low income. Maybe they have a stock position. I had a client that was a lifetime UPS employee, and that employee had a ton of UPS stock that he had retired with. And I was shocked. I met this gentleman early in my practice career. He had millions of dollars of UPS stock that he, just as a delivery guy, had gotten over the 35-year career. As he neared retirement, he was concerned that he had all of his stock in this one company. And if something happened to that company, his entire retirement would be lost. He wanted to diversify, but he also had this stock at a very low basis so that if he sold it, he'd take a huge capital gains hit. So what we did with this gentleman was we created a charitable remainder trust, and he put some of that stock into a charitable remainder trust that went to the charity. The charity was then able to sell the property without a capital gain and then diversify the stock portfolio, greatly increase his income stream. And that worked out fantastic. The slide we have here is dealing with this idea, the same concept, but with an apartment building. Since we're a real estate committee, we're dealing a lot more with, again, real estate. The same concept. You've got an apartment that's worth $3 million. Its basis was $100,000. Gentlemen, we see these things all the time in our respective fields. Somebody bought a property in the 50s and 60s here in Burbank. And Chris nods his head because he and I have talked about many clients that we both have had these issues that we've been encouraging to take this step to look into these planning tools. Clearly, if that person sells that apartment and just deals with the capital gain, that's a $2.9 million capital gain or a $957,000 tax bill, right? If they were to pay that and then invest the remaining funds of a little over $2 million and got a 7% return, which even that return is probably a challenging return in a market like this, they're looking at $143,000 in income. Instead, if those people put that same asset with a low basis at $3 million, donated it to the hospital through the use of this charitable remainder trust, the hospital gets to sell that property and they have the full $3 million available to then pay an income stream back to those people of $210,000 on a given annual basis at 7%. And obviously that's a significant increase almost a 50% increase in income. And so for many of my older clients, they're very focused on income. The idea that they want to live off the income of an asset is really where their mind is. And for those people, again, this is a fantastic tool because you can clearly show that it avoids their worries about diversification or a dilapidated apartment or having to manage something, and turns a low income producing asset into a high income producing asset that takes the risk and the work out of their lives. So really valuable opportunities if we have, again, the right donor, and we have tons of these types of donors that are out there. If we look at the estate tax situation, we've been talking about capital gains. If you look at this scenario and says, okay, not only does this person that created this charitable remainder trust avoid capital gains taxes, but if that person was also subject to estate taxes, then you look at the difference in what the scenario is, and it's even more dramatic. The estate tax scenario right now provides a 40% tax on the amounts above the exemption. The exemption amounts are how much you can leave estate tax free to a non-charity, to your family, your friends. Right now, that number is the highest it's ever been in American history, $11.7 million. But we're going to see later that is one of the key things that the Biden administration wants to reduce, and they want to reduce it dramatically. And so the likelihood that more and more people are going to be facing an estate tax, I think, is very real. And if you then layer in a 40% tax on an asset that's going to get hit when a person passes away, along with the capital gains hit that's there, you really start to see that. Again, with a $3 million asset that becomes $2 million and change after capital gains taxes, if that remaining $1.1 million was then subject to estate tax in a person's estate after they passed away and got hit with another 40% estate tax of almost $500,000, you begin to see quickly the IRS out of that $3 million asset gets almost over $1,400,000. And the heirs in that scenario get a little under $1.6 million. So it just dramatically highlights the reality of what these taxes can do to somebody's estate and how much more thoughtfully we can help potential donors plan where they want their money to go and what good that money is going to do. Okay. Now, again, the last line here, we kind of talks to that idea that for clients that said, okay, well, if I create a charitable remainder trust, it's going to create income for me or somebody else in my life for a period of years. And then when I pass away, it'll go to the charity. I still want to create an opportunity to be able to give something to my kids. Again, we always have the opportunity to layer in the use of insurance for those clients and create a source of funds that could potentially replace the value of the asset that would be left to the kids. And that's sort of what that bottom figure here, where we're saying, hey, we're maximizing the amounts to charity, the maximizing amount to heirs, and zeroing out what Uncle Sam's going to get, because there would be no capital gains and there would be no estate tax. So go to the next slide. Again, you see this asset here, assets placed in the charitable remainder trust, getting the income for life, that same structure. You could use life insurance then on a portion of that income to create a wealth replacement for the family. And in this scenario, as you see it lay out, you've got, the charity basically gets the value of this asset. You replace funds for the family. And in many instances, you've increased income for a potential donor. We'll go to the next slide. Now, charitable remainder trusts they come in two types primarily: a charitable remainder annuity trust, CRAT, a CRAT, and a charitable remainder unit trust, or a CRUT. Okay. Estate planning professionals love their acronyms, and so you'll hear people throw these words out all the time. And if you want to sound obnoxiously in the know in this area, you can start dropping those into your dinner conversations, and I'm sure people would be really quite impressed, or maybe not so much. So with the CRAT, we've got it's basically it is what it says. It's an annuity. So you've got a fixed payment. Basically, you give a donation. In our example before, you know, or in this one, you get $100,000 to the hospital. You get back an annuity, say that pays 6-7% for life, and you get that payment every year. It's fixed. You know what it is. You don't have to worry about that number going up or down. So for people that want the certainty of having that payment at that same amount, a charitable remainder annuity trust works great. Next slide. A CRUT is a little bit more like maybe, you know, your stock portfolio that goes up and down. The idea is it's the same thing. You make a charitable gift that's going to go as a remainder gift to a charity, to the hospital, as we're talking about. But it's structured in a unit trust where basically it allows the asset invested, and they are valued usually at the beginning of the year. And whatever their value is at that point, you get the percentage on that. So first year you donate $100,000, you get 7% of that $100,000. If you invested that money and it grew in value in an underlying investment portfolio, and it grows to 110,000 the next year, then you'd get 7% on the 110,000. Okay. On the flip side, if it went down, you'd get 7% on a lower number as well. But it does offer the opportunity for growth in those assets that can obviously be a hedge against future inflation. The nice thing about these charitable remainder trusts is you can continue to have a great deal of say in terms of how those funds are invested, in terms of how they're structured. And so in that sense, it becomes like another charitable, like another investment portfolio, but it simply has this charitable end and a charitable remainderment, which is the hospital. Okay, we'll go to the next slide. This concept is sort of the final twist of the basics in charitable remainder trust, a charitable lead trust. And all that does is it switches who's going to get the income and who's going to get the remainder gift, right? The charitable remainder annuity or unit trust, the donor gets the income and the charity gets the remainder gift that's left when the donor dies. In a charitable lead trust, you flip those things and the charity gets the income stream for a number of years. And then upon the end of that term, the gift then goes to family members or to individuals. And you can structure these gifts where through the use of charities and the nature of the assets, you can many times, you know, what we call in our industry, zeroing out these assets for estate tax purposes. So in other words, the value of the income stream that you give on a particular asset basically equals the remainder value that's left. And so effectively, you give a period of years of income to this charity, and then upon your death, the asset then passes to your children, if that was the goal, estate tax free. And so again, using our orchard apples and trees example, at the bottom here, you see you let charity pick the apples for a few years, and in the end, the kids will get the trees. Okay, it's just another version of that. So you see this sort of graphically here. They place an asset in the charitable lead trust. The charity then is going to get the income. The children will receive the remaining assets upon their passing. Okay, so this whole idea of these charitable gifts, again, government's taking our money through our taxes. I think a lot of people have some serious concerns about how the government actually uses that money to benefit the people groups that they're saying that they benefit. Private charities, obviously a totally different ball of wax. They're able to put these funds to use and significantly impact the community. I share this with my clients a lot. The idea of these large charitable gifts for families that have significant assets that could potentially be used. I tell people it's sort of this concept in my mind. It's almost like a capitalistic approach to social welfare. These families have health sometimes, or they have an asset that need to live on, and they have an opportunity through the strategic use of planned giving to partner with different charities and to allow their funds and that money to then do incredibly good things in the community. And they get to decide which charity it's going to go to, and they get to do their due diligence to have a peace of mind about how that charity is going to positively impact the community. And it's not just given this tax payment that we see go to, $100,000 gold toilets, and we've all been around long enough to hear the stories of government waste. We get to see our dollars at work. And today in our meeting, we saw the emergency room, the emergency department going up, and our dollars making a significant impact in our community. This hospital has made a significant impact in this community. They've saved lives and the hundreds of thousands over the years. And we all have family members who are walking around here today that likely wouldn't had they not had the services of the hospital. And so, again, you talk about, we get to represent perhaps the most impactful charitable organization in this region in terms of touching people's lives. And we have an opportunity to be able to share that story. And again, this charitable trust concept is just a great strategic way to be able to help people understand some new and significant ways they might be able to partner to make an even bigger impact in the future. So let's go to the next slide here. It's the last slide in the presentation. And this just talks about, again, some of the tax changes that are being reported are either being proposed, have already been presented in Congress, or were part of Biden's election campaign and are goals to be presented and are likely to be presented in the next couple months. First one we see here, the top income tax rate being increased from 37% to 39.6%. That one has already been publicized pretty widely. That's obviously a significant increase, but I think when you look down at the next one where we see long-term capital gains rates being basically done away with, basically changing the idea that capital gains should be taxed at a rate that's different than normal income. That's being floated and proposed by the Biden administration. That obviously would have a radical impact on this whole concept of capital gains and the benefit of avoiding capital gains that we've already covered in my presentation here. If in that scenario, if you were talking about a long-term capital gain rate that's changing from 20% up to 39.6, that's effectively doubling that tax hit. We all know how much capital gains avoiding capital gains already keeps people from selling things and as a powerful motivator for people's financial decisions. Imagine if that rate was doubled. How much more significant is that avoiding that tax going to be in people's minds? And again, these charitable trusts do exactly that. And so the examples that I gave previously, based on today's tax dollars, you realize how much more dramatic those proposals start to look when you can avoid that almost 40% tax on capital gains. You add that to the desire to significantly reduce the estate tax exemptions. I talked earlier about how the current estate tax exemptions are $11.7 million, again, highest they've ever been in American history. The Biden administration has said that they would like that to be dropped down to $3.5 million, which again is almost dropping it to a third of what it is today. That again is going to bring many more people and many more families now into the estate tax worrying situation. And they want to increase the estate tax rate from the 40% to 45%. Again, you see in both of these instances, by lowering the exemption, increasing the rate, again, a significant potential hit on people's estates when they pass away. Charitable gifts, charitable remainder trust, avoid that estate tax completely, okay? So these big taxes that are coming down are making even more, I think, should make it much easier for us to be able to share this story with people. And it's a much more important concept, I think, in light of these increasing taxes and these increased tax proposals. The last one here talks about the unlimited step up in basis and how that's going to be eliminated, or at least that's being proposed to be eliminated or to be greatly reduced. Right now, that concept, for those that are not familiar, the unlimited step up in basis means that when someone dies and you inherit assets from their estate, you get a step up in basis. Effectively, that means that the capital gains tax liability that was there over the course of that person's life gets eliminated, and the beneficiary receives that asset at its full fair market value at the date the person died. That becomes the new basis. So for, again, some potential donors will take the position, as we've talked about charitable remainder trust and avoiding capital gains. Some of them that don't need the income and don't need money right now might say, well, when I die, that capital gains tax liability is going to go away because we'll get a step up in basis, and my kids can sell it and not have to worry about that gain. And I think that's a valid perception in today's world. Obviously, if that capital gain unlimited step up gets eliminated, which is being proposed, or greatly reduced, the Biden administration is talking about limiting the amount of assets that you can get a step up in basis to perhaps $1 million total. Again, now you have a scenario where the opportunity for people to avoid capital gains, even on their death, is taken away, which again makes all the more appealing the planning options that we've kind of covered today with charitable remainder trusts. So with that, I want to open it up to a few questions, if anybody has any, as we're winding down here the last few minutes before the end of our meeting.
I had a couple of questions, Bob. Thank you. On the charitable remainder trust, so if the asset is put into the trust, does Providence then have control of the property?
Yes.
Okay.
Yes.
And go on.
Yeah, so Providence, so typically it would be put in the trust. Providence would then sell it and the trust, because the trust itself is controlled by Providence. The sale then would not be subject to capital gains tax to the individual donor.
And does Providence hold on to the asset until the donor passes away because they're giving income, or it's still sold immediately?
Yes, no, it's typically going to be sold. Providence, I imagine, like any other large charity, would look at each situation and determine, how they want to have that handled. And I guess it's possible that if you had an amazing opportunity that was just, paying up such incredible income, and it was so valuable to keep as it was, that maybe they would look at it. But typically most charities are going to sell that, liquidate that, get to cash, invest those assets in a diversified portfolio. That's typically what's going to happen.
No, that answers my question. Then I was concerned that we might be talking to brokers to get their clients to bring in to talk about assets, and if it went into the trust, that might preclude a sale immediately, which would dissuade the brokerage community from bringing in clients.
Right, and we had kind of talked about that, I think, a couple of years ago as we were going through, and Providence does a great job of utilizing the professionals that bring them opportunities if that's available, and in this situation, there's no preclusion from that. And so making sure that whether it's the title companies or the brokers or any of those people that have sort of brought opportunities to the table, that if they have a role they can continue to play professionally, then that's certainly allowable and can be done, as long as the rates that they're charging are all market rates, and then they're typically utilized, and they'd get the same commission having it sell through and for many of these, for your broker friends that are dealing with, they're trying to get their clients to sell a property, and they're just hesitant for some reason. Again, there might be a motivation for them to say, hey, would you guys sit down and talk to let's all get together and talk to this potential client who's, hesitant to sell because of these reasons. I think it's a great idea to sell, and this could be another great compelling argument to push them in that direction.
I just wanted to make sure that the remainder trust didn't have a nuance that was different, so that's good.
Also, I just want to add that we actually, a letter was drafted, an agreement that assures brokers that they will get the commission on any deal that they bring to us. So that can put those fears at ease. And I know that we need to let everyone go. I just want to give Joe an opportunity. Did you have any additional information you wanted to add to Bob's presentation, Joe?
So, well, first off, Bob, that was awesome. Thank you. I think that the last piece I would say, just sort of that it applies to that question there, is that a lot of these trusts that we have that are benefiting the medical center are actually outside managed. So, a lot of times CPAs are our friends on these things because they see the tax implications and can bring these ideas up. But a lot of times, if we educate the financial planners too, those folks who are already investing, the brokers, these individuals, other accounts, this can be a good thing too, letting them know that they're not going to lose the business. And they don't necessarily have to be set up through us. Of course, we love if they are, but we have quite a few outside managed trusts where we are just going to be the beneficiary, that remainder beneficiary of the gift.
Bob, I have a question. What's your anticipation as to when this would take place, and would it be retroactive, or what would be the effective date?
I think that the fears about retroactive imposition of a tax law change as of January 1st, 2021 have lessened, I think, considerably, really based primarily on what the Biden administration revealed in their and the one significant tax proposal that they've submitted for infrastructure, where they're wanting to raise corporate tax rates, and we've kind of seen that hit the floor, and that's what he's been negotiating. But that proposal would have an effective date of January 1st, 2022. So if the Biden administration is creating these proposals, I think that there is a sense that, in light of what that's already demonstrated and sort of tipping their hands as towards when they want that to be effective, I think the expectation is in a week or 2 or 3 weeks, if they then present the sort of proposals for income tax and estate taxes, that it seems very unlikely that it would be effective January 1st, 2021 retroactively, but more likely that it would be ahead on January 1st, 2022. But again, there's we've got a long ways to go. There's an evenly divided Senate. There's lots of negotiations to go. We still have filibuster rules that are, being bandied about in the Senate, and that could sometimes require 60 votes to push things through. So, there's a lot of hurdles to cross before we're faced with these as real tax realities, but it is sobering to look at the proposals and start to look at what the environment might look like.
Yeah, because it affects a lot of 1031s. I'm handling a few 1031s and even reverses, and they have to be completed, and it would be very difficult to unwind anything like that.
Yep.
That's another thing you didn't mention though, Bob. I think they're going to try to eliminate 1031s with more than 500,000 in gains. So that's another thing that has to be taken into account for some of these folks. And then the other thing that's kind of interesting, particularly for people that have, single family residences that they're thinking about donating, property taxes have really changed too in the last year. And it used to be this great deal to pass on a house to your kids, but I'm not sure that that's really, unless they're going to live there and under a certain amount of value, I don't know that you're going to continue to be able to use that property tax that your parents had. And so I think that's going to be an issue. And there's just a whole lot of changes that are taking place right now in our world that really going to make this program sing. And hopefully we'll be able to get a few more people to the table that's going to really be benefit.
Yep.
So Bob, thank you so much. What an amazing presentation. Way more than I thought you'd get into, but totally appreciate it, and captivating, my man. Thank you so much.